Trading psychology. How the mindset makes or breaks your profits. Before we dive in, advertisements may pop up in this video. Please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Most traders spend years obsessing over technical indicators and algorithmic patterns, yet they wonder why their capital allocation strategies consistently fall short of their performance benchmarks. It is a harsh reality of the financial markets that you can possess the most sophisticated institutional-grade toolkit, but if your internal risk processing is flawed, your portfolio will eventually reflect that instability. The difference between a retail participant and a professional managing wealth for accredited investors isn't just the size of the balance sheet. It is the mastery of psychological capital. When we discuss wealth preservation and the pursuit of tax-sheltered growth, we aren't just talking about numbers on a screen. We are talking about the biological and emotional response to volatility that either secures your financial future or dismantles it. To truly master the art of long-term profitability, we first need to understand that the human brain was never biologically designed to trade financial markets. Our evolution favored a fight-or-flight response which served us well in the wild, but acts as a direct inhibitor to effective liquidity management. When you see a sudden drawdown in your portfolio, your amygdala triggers a stress response that is identical to facing a physical threat. This biological survival mechanism compels you to exit positions at the worst possible time, often right before a market reversal, or to overleverage in a desperate attempt to recover losses. Recognizing that your natural instincts are often your greatest liability is the foundational step toward achieving institutional-level discipline. This leads us to the concept of the cognitive bias, which acts as a silent tax on your annual returns. One of the most destructive forces in asset-based lending and individual portfolio management is confirmation bias. This occurs when a trader falls in love with a specific narrative or a particular sector, such as emerging tech or green energy REITs, and begins to filter out any data that contradicts their bullish thesis. They ignore deteriorating fundamentals or shifting interest rate environments because their ego is now tied to the trade. A professional approach requires you to remain emotionally detached from your holdings. You are not a fan of a stock or an ETF. You are a cold, calculating allocator of capital whose only loyalty is to the preservation and growth of that capital. As we move deeper into the mechanics of the professional mindset, we have to address the paradox of the perfect trade. Many investors struggle because they are seeking certainty in an environment that is built entirely on probabilities. This is where the bridge between US-centric markets and global hubs like London, Dubai, or Singapore becomes relevant. Regardless of whether you are navigating the regulatory framework of the SEC or the tax-efficient structures of the UAE, the mathematical reality remains that no single trade defines your success. Institutional success is built on the law of large numbers. When you view your trading through the lens of 100 trade sample size rather than a single event, the emotional weight of a loss evaporates. It becomes a simple cost of doing business, much like an insurance company expects a certain percentage of claims. Transitioning from a mindset of winning to a mindset of expectancy changes the way you view risk management. Most people focus on how much they can make, which is a greed-based perspective. Professionals focus on how much they can lose, which is a sustainability-based perspective. This shift is essential for anyone interested in retirement planning techniques or complex capital allocation. If you risk too much on any single idea, the fear of loss will cloud your judgment, leading to hesitation or revenge trading. By keeping your position sizes small enough that a loss does not impact your lifestyle or your long-term wealth strategy, you empower yourself to make rational, objective decisions. There is a subtle but vital difference between being a disciplined trader and being a rigid one. The market is a dynamic entity that requires constant adaptation. In the United States, for instance, a shift in Federal Reserve policy can instantly alter the risk premium across all asset classes. A trader with a fixed mindset will fight the market, insisting that the macro environment should be different. An investor with a professional mindset accepts the market's reality without judgment. They understand that their job is not to predict the future with absolute certainty, but to position themselves to profit from whatever reality unfolds. This level of psychological flexibility is what separates those who build lasting generational wealth from those who are merely lucky during a bull market. We also need to consider the impact of recency bias on your portfolio management. This is the tendency to believe that what happened in the very recent past will continue to happen in the near future. If you have had 5 winning trades in a row, you might feel invincible and decide to double your risk on the 6th. Conversely, after a string of losses, you might be too paralyzed to take a high-quality setup that meets all your criteria. Both reactions are equally dangerous. To combat this, elite performers utilize a rigorous feedback loop. This involves maintaining a detailed log that tracks not just the entry and exit prices, but also the emotional state you were in when you executed the trade. Over time, you will begin to see patterns in your behavior that correlate with your P&L, allowing you to optimize your mental performance just as you would optimize a financial model. While the primary focus for many is the high-volume U.S. market, it is important to realize that these psychological principles are universal global bridges. Whether you are looking at property trusts in Australia, the FTSE in the UK, or tax-advantaged accounts in Canada, the human element remains the constant variable. Greed and fear do not respect borders. Therefore, the strategies you develop to manage your internal state are portable across any asset class and any jurisdiction. This universality is why top-tier institutional firms invest so heavily in performance coaching and psychological screening for their desk traders. They know that a brilliant mind with a fragile temperament is a liability, not an asset. Another critical component of the professional mindset is the ability to handle boredom. Real, sustainable wealth generation is often quite repetitive and frankly unexciting. It involves waiting for the right conditions, executing a proven strategy, and managing the risk. Many retail traders fail because they treat the market like a casino, seeking the dopamine hit of a big win or the rush of a volatile move. This action bias leads to overtrading and the erosion of capital through commissions and slippage. Developing the discipline to do nothing when there is nothing to do is perhaps the most underrated skill in the world of high-level finance. As you begin to apply these insights to your own capital allocation, you will find that your stress levels decrease as your consistency increases. You stop looking for home runs and start focusing on the base hits that lead to compounding growth. You begin to value your mental peace as much as your financial gains, understanding that a clear head is your most valuable trading tool. This is the ultimate transformation, moving from a participant who is at the mercy of the market's whims to a strategist who commands their own responses. To summarize the journey we have taken today, remember that your mindset is the filter through which all your technical and fundamental knowledge must pass. If that filter is clogged with ego, fear, or greed, the output will always be suboptimal. Prioritize your psychological development with the same intensity that you study the markets. Focus on the process of being a disciplined trader, and the profits will naturally follow as a byproduct of that excellence. Start by auditing your recent trades not for their financial outcome, but for how well you followed your own rules. If you found value in this deep dive into the psychology of wealth, make sure to like the video and share your thoughts in the comments below. I am particularly interested in hearing which cognitive bias you find most challenging to overcome in your own journey. For more insights on institutional-grade strategies and long-term portfolio management, subscribe and join our community of dedicated investors. This content is for informational and educational purposes only and should not be considered financial advice. Investing involves risk, including the potential loss of principal. Please consult with a qualified financial professional before making any investment decisions.